Good day, everyone. For today's lesson, we will tackle about the different branches of accounting.
Branches of accounting consists of financial accounting, management or managerial accounting, government accounting, auditing, tax accounting, and cost accounting.
Financial accounting. This is a process of recording, summarizing, and reporting the myriad of transactions resulting from business operations over a period of time. These transactions are summarized in the preparation of financial statements, including the balance sheet, income statement, and cash flow statement that record the company's operating performance over a specified period. This is one of the most important distinctions from managerial accounting, which by contrast involves preparing detailed reports and forecasts for managers inside the company.
Why is financial accounting important? Financial accounting is important for businesses because it helps them keep track of their financial transactions. In turn, they can make sound decisions on how to allocate their resources.
Management or managerial. Management accounting is a field of accounting that focuses on evaluating finances to generate internal financial reports and records that help managers in various departments to make better decisions and drive corporate value. Management accounting helps an organization's top management and decision makers to make sense of financial data by translating it into meaningful figures and statistics. Reports can be made as per specific needs of managers or individuals' functional areas, such as marketing, sales, or manufacturing.
As stated in FreshBooks, managerial accounting is an accounting branch that deals with interpreting, measuring, analyzing, identifying, and communicating information to managers. It helps managers to make operational decisions that will help them to achieve their business objectives. One example of management accounting that I can give is that let's assume a sportswear company might measure the percentage of defective products produced or the percentage of on-time deliveries to customers. This kind of non-financial information comes from the managerial accounting function.
Five techniques in managerial accounting that will help a business to increase its values. First, margin analysis. Companies use marginal analysis as a decision-making tool to help them maximize their potential profits. Second, constraint analysis. Constraints are defined as anything that limits a system from achieving higher performance. Third, capital budgeting. The capital budgeting process is a measurable way for businesses to determine the long-term economic and financial profitability of any investment project. Fourth, trend analysis or forecasting. Trend analysis is a technique used in technical analysis that attempts to predict the future movements based on recently observed trend data. Fifth, product costing or valuation. Product cost refers to the costs incurred to create a specific product.
Government. Government accounting refers to the process of recording and the management of all financial transactions incurred by the government, which includes its income and expenditures. Government accounting maintains tight control over resources while also compartmentalizing activities into different funds to clarify how resources are being directed at the various programs. This approach to accounting is used by all types of government entities, including federal, state, county, municipal, and special purpose of entities.
Government accounting focuses on the government's financial expenses. In government, in government accounting, all the financial transactions are recorded in the government office. Example of government accounting is that instead of acquiring and spending funds received from customers, or clients as a for-profit company would. Governments collect and spend tax in what are known as non-exchange transactions with citizens.
Auditing. Auditing is a branch of accounting that is usually done internally and externally. Auditors examine and monitor a business for accurate reporting, compliance with tax laws and regulations, and financial integrity.
Auditing is one of the most crucial branches of accounting, and companies spend millions every year to ensure auditing compliance. It involves the process of reviewing, examining, verifying, and evaluating a firm's financial accounts and the system of internal control. This process is carried out by auditors who may be internal or external.
There are two specializations for auditors. First is the external auditor. This is a state or federal auditing that takes place with an independent outside auditor who examines a company's financial statements for accuracy. Auditing complies with GAAP and evaluates the adequacies of a company's internal controls. External auditors may test the company's segregation of duties, policies, authorizations, and other management controls for efficacy and integrity. Second is internal auditor. Internal auditing identifies and prevents tax issues or prepares the business for an outside audit. Auditors in this branch are typically chosen by shareholders, so their role doesn't present a conflict of interest and ensures their objectivity.
Tax accounting. Tax accounting involves planning for tax time and the preparation of tax returns. According to Julia Kagan, tax accounting is a form of an accounting process focused on taxes. This branch of accounting aids businesses. It helps businesses figure out their income tax and other taxes and how to reduce their amount of tax owing legally.
Tax accounting also analyzes tax-related business decisions and any other issues related to taxes. The following are the three types of tax accounting. First, tax accounting for an individual. Second, tax accounting for a business. Third, tax accounting for tax-exempt organizations.
Cost accounting. Cost accounting is a type of managerial accounting that aims to capture a company's entire cost of production by measuring both variable and fixed costs, such as a leasing fee. Management uses cost accounting internally to make fully informed business decisions. Unlike financial accounting, which gives information to external readers of financial statements, cost accounting is not bound by any standards and can be flexible to accommodate management's needs.
Cost accounting. Cost accounting takes into account all production-related input costs, including both variable and fixed costs. Standard costing, activity-based costing, lean accounting, and marginal costing are examples of cost accounting types.
Understanding cost accounting. First, determining all variable and constant expenses. The internal management team of a business or a company uses cost accounting to determine all variable and constant expenses connecting with the manufacturing process. Next, compare input costs to output results. It will first measure and record these expenses individually, then compare input costs to output results to aid in financial performance measurement and future business decisions.
Third, Third, useful tool for budgeting management. Cost accounting may be extremely useful as a tool for management in budgeting and is establishing cost control programs that will help the company's net margins. Fourth, categorizes expenses based on management information needs. Cost accounting does not have to fulfill any set standards such as generally accepted accounting principles because it is utilized as an internal tool by management. As a result, it varies in use from company to company or department to department.
Types of cost accounting. First is the standard costs that are based on the most efficient utilization of labor and materials to create the good or service under normal operating conditions, and they are essentially the budgeted amount. Standard costing. Variance analysis is the process of determining the difference between and the actual cost spent. Second, using activity-based costing, which define cost objects like commodities or services. As a result, when managers analyze the costs and profitability of their company's unique services or products, activity-based costing tends to be much more accurate and helpful. Third is lean accounting. Lean accounting's main purpose is to improve an organization's financial management methods. For example, if an accounting department is able to reduce wasted time, staff can use that time more productively on value-added tasks. Fourth is marginal costing. Marginal costing can assist management in determining the impact of various cost and volume levels on operational profit. Management can use this type of analysis to learn about potentially profitable new items, sales pricing to set for existing products, and the impact of marketing activities.
These are the advantages of cost accounting. First, waste, losses, and efficiency are eliminated. A good cost accounting system removes waste, losses, and efficiency. Second, cost reduction. Under the cost reduction accounting system, new and enhanced production methods are used. It results in cost reduction. Third, determines the causes of profit or loss. A good cost accounting system identifies the reason for profit growth or decline. Management can take corrective measures to keep the company or the business profitable.
Fourth, advice on choosing whether to make or buy. The management can determine whether to create or buy a product on the open market based on cost information. The management has the ability to select the best out of many alternatives. Fifth, fixing of prices. The costing records contain the total cost of a product. It is highly beneficial in price fixation of products. That's all for today's lesson, Branches of Accounting. We hope you have gained knowledge about this topic. Bye!